It wasn't a very good week this past week for the stock and bond markets. So now what? This past week was a down week for everything except Bitcoin and intermediate treasuries. But before we get into that, I developed a new metric for evaluating the risk and opportunity of a stock, an ETF, an index, or an arbitrary basket of stocks or ETFs. Right now, we're beta testing the new metric going forward, and so far, it looks like it's more reliable and more responsive as a stock or an index starts to drop after going up, or as a stock or an index starts to go up after it's been dropping, which is exactly what you want. To illustrate this, let's take a look at how the new metric performed selecting a small basket of 7 stocks out of 500 over the past 5 years, and then how it performed selecting a portfolio of 10 sector ETFs out of, I think, about 30 over the past 20 years. So as you can see here, the graph on the left shows the old metric for selecting stocks. And again, this is a 7-stock portfolio selected out of a pool of about 500 stocks. And you can see the red line is the S&P 500, and the blue line is the portfolio using the old metric for selecting stocks. On the right, we show a 7-stock portfolio against the same exact 500-stock pool, but we're using the new metric to select the stocks. And again, you can see the S&P 500, but you can see that this outperforms the old metric over here on the left. And these scales are exactly the same from graph to graph. So you can look at these and compare them side by side. But this one clearly ends up a little bit higher, but it really performed better over this period, where this one had a pretty long downdraft here. And what if we look at sector ETF selection? Now here we've got a smaller pool. It's a pool of, if I had to guess, I'd say it's probably about 20 to 30 sector ETFs. But if we look at the old metric on the left, you can see how the strategy performed versus the S&P 500. And then if we look at the right with the new metric, you can see that it performed much better overall. It ended up higher at the end, ended up doing better down here, you can see that here, and ended up performing more smoothly through this period. So this looks really, really promising to me. So as I go through the current state of the markets, I'll compare the old metric to the new one where it makes sense and it applies. Please let me know your thoughts and ideas in the comments below after you look at these results and compare the old metric to the results from the new metric. So far, August is living up to its reputation as the worst performing month in the year, but we still have a long way to go before September 1st. So let's take a look at what we're seeing now. So as you can see, if we look back over the past week, equities performed very poorly, and this is a very unhealthy looking week here. You've got ARK Invest way down, followed by the NASDAQ, followed by the S&P, followed by small caps, followed by the Dow, but all of them are negative for the week. This is an unhealthy looking stock market. And if we look back over the past month, you can see that things really started to collapse here in this last week, and this is starting to look a little bit unhealthy. But if we look back over year to date, this is a very healthy looking rally so far. We're still in a position where ARK, the most risky stocks, are finishing first, NASDAQ 100 second, S&P third, small caps fourth, and the Dow last. This is what you want to see. And if we look at the bottom dynamics, the current bottom dynamics, you can see that we've had the bottom forming indicator really rising up here to the top. Now this indicates that a bottom is forming, and you can see that the confidence level is shooting up as this bottom forming indicator is going up. So this tells me that we're approaching a bottom. I don't know if we're there yet. We won't have confirmation of that until this bottom confirmation signal comes way up here to the top and the confidence level stays high. But what I can tell you is that it looks like both of these are moderating. This bottom forming indicator kind of went flat sideways here. The bottom confirmation indicator went flat sideways here, but the confidence level is going up still. Now the safety confidence is falling here. So if I put all this together, it's a 50-50 chance. I really can't predict anything from this. Might be a slightly more chance that the market could go up next week, but it's just too close to call with these current metrics. And what if we look at risk versus opportunity? Well, now this is risk versus opportunity using the old metrics, and I'll show you how it looks with the new metrics. But you can see here that the risk level, as you've heard me say in many of my past videos, is in a very good place. It's well below 80 up here. When this gets up to 80, I become really concerned. And if you look at the risk acceleration, the yellow line, yes, they're both pointing higher, which is not good. But I don't get concerned until this one is above 60, like it was back here. So that gave me a little bit of a pause there, but then the market kept going higher after that. Now we'll have to see how this plays out next week and see if these continue higher. I also like the fact that the equity opportunity level is pointing higher here as the market drops. So this looks pretty good to me. Now if we roll over to the new metrics, you'll see they look very different. Not nearly as much noise in these metrics, which I really like. But you can see, just like on the previous chart, the risk acceleration peaked out here above 60, just like it did in the last chart, but has really fallen off, and in fact is falling even as the markets dropped here on Friday. And you can see that the risk level is way down here and just nothing to be concerned about. Now, the one thing that I'm learning how to read these are new, but you can see the opportunity level has really been declining. So that part doesn't look good. So we'll have to see how this works out over the next week or two. And what about equity versus safety? Well, if you've been watching my videos for several weeks, you know that the NASDAQ 100 has been up here in first place probably for the last 12, 15 weeks or so. And then a couple of weeks ago, it dropped down here. And then I was encouraged last week when it came back up here. But now it has really taken a dive. And when I look at this situation that we have here, I do not like the fact that cash is up here in the number 2 position and Dow, the safest stocks, are up here in the number 1 position. This is starting to look very unhealthy. And you can see that the Treasury market is also very unhealthy. You've got the longest duration Treasuries down here at the bottom as you did last week. Now the week before they were starting to look a little healthier, and then if you look back here, they were very healthy. But this is not a good looking situation here. And if we follow the cash, which is what I like to do, if we follow the cash, you can see it kind of went sideways here, nothing to worry about here. Gave me a little pause when it moved up here. Then it moved down even further. This was really good. Moved up a little here, no reason for concern. But now it is sitting right up here in the number 2 spot. So these react fairly quickly, and if this continues, that won't be good. And what are we seeing in the buying and selling pressure? Well, if we take a look here, you can see that the Dow had a nice rally. It's been falling off. Selling pressure above the buying pressure, as you can see here. S&P 500, very similar picture. Selling pressure above the buying pressure. NASDAQ 100 had a nice rally, but flat topped and then has since fallen off. Selling pressure again above the buying pressure. And then ARK Innovation really fell off here recently, and the selling pressure is above the buying pressure. So this doesn't look very good for equities going into next week. And what about the small caps? Same thing. Nice rally, fell off here, and you can see that the selling pressure is well above the buying pressure. Now here again, we're going to contrast the old metrics with the new metrics. So you've seen these sector ranking tables from me before, and the sector rank gives you kind of a longer view. These move more slowly. They kind of tell you where things are or where they've been. And then when we get to the sector rank accelerations, those tend to give more of a leading indicator and kind of tell you where things are heading. But as you can see here, these are the old metrics. And last week, up here on the top, we had a very healthy risk appetite with Bitcoin and all these technology and ARK innovation up here, consumer discretionary up here. And surprisingly, when we move to this week, oh, and by the way, cash was down here, that's great. Surprisingly, when we move to this week, this picture is pretty much still intact. Consumer discretionary has moved up a notch, and cash has moved down a notch, and treasuries have moved down. So this doesn't agree with what we saw in the price action last week, and it doesn't agree with what we saw in equity versus risk. So it'll be interesting to see how this plays out next week. But let's look at the new metrics to see how those compare. So if we take a look at those, here's the same exact sector rankings, but with the new metrics. And you can see very healthy risk appetite here. Technology and ARK up here in number 1, consumer discretionary, Bitcoin, cash way down here, treasuries, gold, consumer staples way down here at the bottom. This looks fabulous last week. And then if we go to this week, not much change here. The risk appetite looks very healthy with innovation, technology, Bitcoin, technology, consumer discretionary, cash way down here, treasuries down here, gold down here, consumer staples moved up a little bit, but nothing to give you any concern. So this is telling me things look pretty good. So now let's take a look at sector rank acceleration. These move much more quickly and kind of give you a sense of where things are headed. And so they're kind of a shorter view. So if we look at last week, we had cash way down here, treasuries way down here. You know, we had innovation, emerging markets, emerging companies, and so on. There was a fairly healthy risk appetite going on here last week, although consumer discretionary was way down here at the bottom and consumer staples had moved up here. Now, if we fast forward to this week, we still have technology, semiconductors here, emerging markets, emerging companies. But you can see that while cash is still sitting down here, treasuries have moved up in the mix, which is not a good thing. Let's take a look at the new metrics when we look at sector rank acceleration. So if we look at the new metrics, last week cash was way up here, consumer staples here. We had Bitcoin and some of the risk assets here not looking terribly great. Consumer discretionary down here. But now if we go to this week, you can see that consumer staples has pushed up even higher, but cash has moved lower and treasuries have moved lower and consumer discretionary has moved higher. So this looks like there's a tilt toward risk, not away from it. So, you know, we're going to have to wait and see how these play out. Like I said, these are new metrics. We're trying them out. And one way to try them out is test them going forward. So that's why I'm putting this out here and look forward to any feedback you might have. Now let's take a look at how treasuries performed over this past week. And you can see they kind of look like the stocks did. They were all down for the week except for intermediate treasuries, which you can see were up about 0.035%. That's just about flat. So not really looking good here for treasuries. What about over the last month? Again, unhealthy looking treasury market. And if we look at year to date, you can see we're right down here near the bottom. So this might be an opportunity to buy long treasuries. Let's look over the last 5 years. Where are we? We're really not far off of this bottom back here in October of 2022. So, you know, these could drop more if interest rates keep going up at the long end. I mean, part of that was due to the downgrades of the U.S. government debt. And when you downgrade debt, what happens? It has to pay a higher yield. So that's what's happening here. And how does that show up in the buying and selling pressure for treasuries? Well, if we look at SHI, which are short-term treasuries, they went up very nicely on Friday. And you can see actually that the buying pressure is moving above the selling pressure. So this looks pretty healthy. And so there was a flight to safety, if you will, in treasuries where people were selling longer duration treasuries and putting their money into shorter duration treasuries. IEI, these are the intermediate treasuries, the only ones that were up slightly for the week. But you can see the selling pressure is above the buying pressure, but it is trending downward. How about intermediate to long treasuries, 7 to 10 year treasuries? Well, you can see even though the price action was up on Friday, The selling pressure is still above the buying pressure. And then the long bond, TLT, again, price action was up on Friday, but the selling pressure is still above the buying pressure. And what about that inverted yield curve? Well, if you take a look, this has actually had quite a move this past week. We were 110 basis points inverted here, another 100 basis points inverted here, big inversion here, and then things have been really trying to correct here. Now, this is mostly because the yields on the long bonds have gone up. This move toward being uninverted is being caused by the long bond yields going up because of the downgrades of the U.S. debt. So what it's going to take for this to become uninverted is one of two things, or both, right? Yields on the long end and the long bonds either have to keep going up, which may not be a good thing, and or yields on the 2-year treasuries have to go down, and the Fed controls those. So until the Fed relents on hiking interest rates, this is not going to get to a point way up here off the chart where it's uninverted again. Now, if we look at the Fed rate monitoring tool, it's interesting. Right now there's a long way to go. We've got 6 weeks, 3 days, 23 hours, and 9 minutes to go until the next Fed meeting. You can see right now there's an 87% likelihood that the Fed will not raise rates at all. In other words, leave rates flat. There's only a 13% chance that they'll raise by another 25 basis points or 1/4%. Now, we have a long runway to get there, and this can shift around a lot. This could shift up to here, where the market thinks that the Fed's going to raise, or it could shift down to a spot that's not shown here, where they actually lower rates. I kind of doubt that'll happen, but it'll be interesting to watch this over the next few weeks. So what about gold? Well, gold has been kind of going nowhere, sideways to nowhere. It's been kind of trading in a range. It's been trending downward lately, except for Friday when it went up. You can see the selling pressure well above the buying pressure, but it is trending down, and the buying pressure's trending up. And what about Bitcoin? Well, as I've said every week now since this happened, we had Fidelity and BlackRock indicating they were going to try to get Bitcoin ETFs approved, and the result was a huge uplift in the price, and the buying pressure went off the chart, through the roof. Now you can see since then it's moderated a bit, but this is one of the few assets that moved higher this last week. And Cathie Wood had some interesting things to say about it. Take a listen.
Bitcoin, new asset class. After the excitement about BlackRock's ETF filing for Bitcoin in June, which rocketed Bitcoin beyond 30,000, it has come down a bit. It's around 29,000 now. And even more notable is the volatility has come down dramatically. In fact, we haven't seen this low of volatility since 2020, right before it embarked upon a major move. Now, sometimes volatility means that it's going to break down. So when there's very low volatility, you look for signs of, is this going to break out or is it going to break down? Given our on-chain analytics, we're on the bullish side, and we just put out the Bitcoin monthly this week, and you'll see those signals. On balance, they're very positive. So the internals of the market, the on-chain analytics, are telling us that we're probably, if there's going to be a break either way, it will be a breakout to the upside. And as you'll remember, the last highs were 70,000. And this has been a market that has been moving. It's been moving such that we have higher highs and higher lows with each cycle. It's very volatile, of course, as we all know, but higher highs and higher lows means we're in a secular bull market.
I'll put a link to Cathie Wood's video in the pinned comments below. As I said last week, look, we could be in for a few weeks of non-committal behavior from the stock market until the retail investors and money managers get off their beaches and boats and get back into their offices in September. Until next week, then, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
You got that something brand new. You got me thinking it's you I'm missing. I've seen the world, but nothing's better than loving you, girl. I've been waiting time and time again. I've been searching, but nothing else will do. It's gotta be you. got that fresh look, long curves. You got my head turning time and again. You got that something I need. You got me thinking it's you I'm missing. I've seen the world, but nothing's better than loving you, girl. I've been waiting time and time again. I've been searching, and nothing else will do. It's gonna be you. I've seen the world, but nothing's better than loving you, girl. I've been waiting time and time again. I've been searching, but nothing else will do. It's gotta be you. It's gotta be you.